I think that there's a mistake about interest rates that has been driven in this market that, down is good, zero is the best, and negative is even better, and that up is bad. And that is not always the case with interest rates. Interest rates is a cost of money. You'd like to see money be appropriately or fairly valued. You don't want it to be undervalued. You don't want it to be overvalued. And I've been arguing that the current level of interest rates is about the appropriate level for this economy. And I would point to stocks at an all-time high, crypto at an all-time high, housing at an all-time high. The economy seems to be moving forward, and we have a bit of a sticky inflation problem. That is not the prescription that interest rates are too high, and that by lowering them, you're going to stimulate the economy. Maybe it doesn't need it. And that is the problem that we faced last year. It didn't need it. And when you stimulate an economy that doesn't need it, you wind up just pushing prices up, which is inflation. And then you wind up pushing interest rates up to undo what you've done with trying to stimulate the economy. And that's the risk I think we face in the markets right now. Historically, inflation has been a destroyer of economies. It's been a destroyer of cultures. It is the single worst thing that you could do from an economic standpoint to an economy, war obviously being the worst. And the reason is, and you can look at it in the latest data, I'll say this forcefully to get my point across. Indeed, the job posting website has a blog where they do some economic research about the labor market. They posted last month some data that they got from the Atlanta Fed looking at wages. And about 35 or 40% of the US economy, people have jobs where they're not getting raises of 3%. The core inflation rate is 3%, meaning prices are rising faster at the store than their paycheck. They go to the store, they got to buy less stuff every month because of that. Now, those are the people in the bottom 35 or 40% of income. They're not rich people that have this problem. They're poor people that have this problem. They don't own assets. They probably rent. So screw them, because we want assets to go up and we'll just leave them behind. That's the risk you face. And that's why I said, if you wind up tolerating inflation and you wind up, allowing it to go up because it benefits a certain group of people, asset holders, this is how you have revolutions in UN societies. And this is why I think that inflation cannot be overestimated, and how important it is that you have to bring it down. You have to get to the Fed's goal of 2%. What worries me about this is the inflation rate is above 3. There's only been 2 times in the last 40 years that they've cut rates when it's been above 3. Last year, and it didn't work out very well because long-term interest rates went up. And 34 years ago, they did it as well too. And it didn't work out very well because long-term interest rates went up. So now they're going to try this again. They're going to try and cut rates with a high inflation environment defined as core inflation above 3, hoping that it is the right strategy. We'll see what they go. Obviously, from the way I'm framing it, I'm kind of skeptical that it will be. But, I want to try and be open-minded and see what comes, but I'm not very optimistic. There's 2 verboten categories in economics that we're not allowed to talk about because everybody stares at their shoes and wishes you would stop talking about it. One is the impact that the pandemic had on the economy, and the other is immigration and what its impact has been on the economy. I've argued in our lifetime, the biggest economic event is the pandemic. It's bigger than the financial crisis. It's bigger than any war like the Gulf War or the stock market crash 87. It changed our economy in ways we are not fully understanding. The labor market is a different market because of remote work, and it was accelerated because of the pandemic. Deglobalization was accelerated because of the pandemic. Tariffs are now probably an artifact of what happened during the pandemic. And we cannot emphasize that this economy is not the 2019 economy. And yet you hear people always talk about, is the economy normalizing? That's Jay Powell says that, or returning to pre-pandemic levels. That's a different cycle. That cycle's over. And by the way, along with that cycle being over, from a market standpoint, I would also argue zero interest rates. That was an experiment from 2010 to 2020 that is now over. Yet I hear people all the time, don't worry, the next time the market wobbles, the Fed will cut rates to zero and they'll print money. That is a different cycle. That would be akin to arguing that we're going to return to the gold standard. That's another old cycle as well too. So the economy is completely changed because of the pandemic, but yet we still want to argue this is a pre-pandemic economy. We're going to go back to 2% rates. We're going to have slow growth. We're going to have interest rates go down to 1%, as President Trump wants to put it at as well. Other one I would argue is immigration. We don't want to talk about immigration. The biggest thing about the labor market is that the labor market, we call this the supply of labor versus the demand of labor. There's 164 million jobs in the United States. When we look at the unemployment rate, we survey 120,000 households, or at least that's the goal, to try and figure out what the unemployment rate is in the country. Let me restate that. These are measures of the population of the United States. What is the biggest driver of whether or not we have strong growth or weak growth on jobs is population growth. Now, one other quick statistic. What is the biggest driver of population growth? It is not fertility, because the fertility rate in the United States is the lowest it's been in its history right now. It's immigration. So from 21 to 23, when we had 3 million people come into the country, the population of the country exploded higher to a 20 or 30-year high population growth, largely because of immigration. Every day, thousands of people came into the country. The supply of labor ballooned. It pushed down wages, and you saw payroll growth expand because there were people out there looking for jobs. After Donald Trump became president again in January, he has slammed the border shut. At the beginning of the month, he put out a Truth Social post saying that we have net negative immigration for the first time in 50 years. Now, net negative immigration means more immigrants leaving the country than entering the country. And he said for the first time in 50 years, that's only because we have 50 years of data. You could actually argue it's the first time in American history that our flow of migrants is now negative in the country. Given the low fertility rate and a negative flow of migrants, we have probably dramatically changed the population growth of the country to one of its lowest levels in American history that has not been involved with the Spanish flu of 1918 or a war like the Civil War. And we had negative population growth because people were literally dying in the streets then, but take those out because we don't have those situations. We have no population growth. So what is that? What am I leading up to? We freaked out about a big revision down in jobs, 19,000 jobs being created in May, 14,000 jobs being created in June, 73,000 jobs being created in July for a 3-month average of 35,000 jobs. And we said, that's too low. The Fed's got to cut rates. We can't have this. We're going to have a recession. No, that's fine. That's all we need in terms of jobs if you have no population growth. The American Enterprise Institute takes it one step further. They did a paper and they said by 2027, anything above zero in payroll report might be enough. And so this is the big mistake I think we're making, is that we think this is pre-pandemic. We still think we should be creating 100 to 150,000 jobs a month. Only way you're going to do that is you're going to stimulate the economy by lowering interest rates. As far as the long bond goes, let me say this, that what you've seen in the TradFi markets, especially things like ETF flows, is a tremendous flow of capital or money into fixed income assets. Now, why? Because there's a yield there right now for the first time ever, and if we wind up having more yield to observe because of the reaction in the market, the bond market stands as an alternative to the stock market. Remember the old Tina, there is no alternative? There is. It's called the bond market now because you can get, somewhere near 5% yields, investment grade yields when you consider corporates and the like. You can get a 5% yield. And for a vast number of people with a certain risk reward profile that is less riskier, than younger people that want to chase crypto, older people. The biggest mistake I think people make with their investments is they need to adjust them for their risk profile. If you are close to retirement, you should be largely in short-term fixed income assets. Because look, if you're 64 years old and you're speculating in NVIDIA and you're speculating in Bitcoin, you better be independently wealthy, because at that point at 64, your net worth is your net worth. And you should be worried more about losing it than saying, if it could only just double before I get to 70 or something like that. And look, if you're 34 years old, that's a different story altogether, because if the markets fall, you still got decades to kind of work through this problem. You don't have decades if you're 64 years old. But that's the biggest mistake. So those people should be more in fixed income assets, and they are now because of the yield. So if yields go up, there could be a tremendous sucking sound in the TradFi markets of people pulling into fixed income assets because they offer a reasonable alternative to the stock market. Interesting dynamic that's happening in the stock market in the last year or so. Remember, we talked about this in 21 when we had GameStop with the meme stocks and the retail investor was dominating the market. Then in 22, the market sold off and the retail investor kind of went away. Well, in the last year or so, the retail investor has come roaring back with a vengeance in this market. And meme stocks are back in a vengeance as well too. and you've seen options trading is exploding higher. And it all revolved around, probably the biggest catalyst was Liberation Day. We had Liberation Day, April 2nd. The market sold off 15% in like 2 weeks. If you were a professional investor, what did you do in the immediate aftermath of Liberation Day? You sold the market. You were worried that this was going to lead to a recession and slower growth and everything else, and you sold the market. If you were a retail investor, what did you do on that sell-off on Liberation Day? You bought the hell out of the market. You just went completely all in, reckless abandon, and guess what? Retail investors won huge. It's now the point, if you've ever been on the Reddit boards, there's probably disappointment. They wanted Powell to say something hawkish. They wanted the market to tank like it did on August 1st with the payroll report. They seek, hope, pray. The market collapses because it always comes back. It's always buy the dip. So please give me a dip to buy. So there's no way you're going to shake them out of this market with weak prices. They're more aggressive when the market goes down than less. It's a complete inversion of the way that we understood that retail investors would behave. But if you bring in yields and you take away the high end of the curve, right? The 50 plus crowd just says they're not doing that. It's the lower end crowd that's doing that. And they go, maybe I should move more towards fixed income. It could stall the stock market rally. Because remember, this will always be the case, because even when the millennials and the Gen Zs are 50 plus, the 50 plus crowd always has the money. So that's where the money is. And so if they want to move towards fixed income, it could really sap this market quite a bit.